Hi, I'm Ryan, the Frugal Analyst, and today I will tell you how to get the best loan rates. This video is for anyone looking to borrow or refinance existing debt and want to understand how to get the best deal on a loan. At some point in our lives, we may need to borrow money to pay for repairs, buy a house, tackle an emergency, reduce debt, or whatever the reason is, we need to understand our loan options. There are so many options, and understanding loans and how they work will give you an advantage and let you borrow at better rates. In a nutshell, the four components to getting a good rate are picking the right loan type, choosing the right option, shopping around, and refinancing over time. The first key is to pick the right loan type. Every type have a different interest rate range, so we need to pick the ones we qualify for from the cheapest to the more expensive. In the traditional types, we have car loans, mortgages, HELOC, personal loans, line of credit, credit cards, and payday loans. On the non-traditional side, I see some of the best deals including 0% APR credit cards, 401k loans, cash out refinancing, and seller financing. There are other loan types, but these are the most common. Every loan has different qualifications, the amount you can borrow, and how long you can borrow. The key here is to see which loan you qualify for from the lowest rate to the higher rate. I'll be making more videos on the specific loan types and how they work in greater detail. The second key is to understand loan options. Applying for a loan, lenders might ask, do you want a lower monthly payment? How much can you afford? In reality, the relationship between monthly payment, interest rate, and loan terms are as follows. The longer the term, the higher the interest rate and the lower the monthly payment. This rate sheet example from a credit union website shows how they work. The rate increases as the term increases. At the same time, the minimum monthly payment is smaller with a longer term. Ultimately, lower payment usually means a higher total cost for the borrower. The key is to know how much money you need and how much monthly payment you can afford. The simplest way to get out of debt is to pay it off as soon as possible. Now, in practicality, I'd like to know how much interest it costs with different options. When I see the credit union rate, the APR is labeled as low as. My credit may or may not qualify for the lowest rate, so I would like to know my actual options before deciding if higher APRs are worth the lower payment. Different loan types, like mortgages, might have other loan options like points, fixed or variable rates, and many more. I'll cover the detailed options in another loan-specific video. The third key is to shop around. Yes, applying to multiple lenders takes a lot of work, but every institution has different qualifying criteria and rates. The more you apply, the more likely you will get a better deal. Loans can come from banks, credit unions, online, and local lenders. Try 2 of each type of lender or have a total of 4 to 5 rates from different companies. If you worry about impacting your credit score, ask the lender if they have a soft credit pull to check rates and to see if they have an interest rate sheet before applying. If the lender absolutely must pull hard credit to determine your rate, make sure to apply for multiple lenders at the same time to minimize any credit impact. The same time means within a week of the first application. The fourth key is to reapply or refinance over time. Most loan rates are set at application for the life of the loan. Over time, 2 things might change. First, your credit. If your credit improves, it might be time to reapply for a loan to get a better rate. The second is market condition. Lenders must borrow money from somewhere to lend to customers, and the 10-year treasury is a pretty good gauge of where the rates are moving. If the index goes down, there is a good chance that loan rates also go down. If it goes up, there's also a good chance that loan rates go up. The key here is to track the market rates and your credit to see if there are any significant changes. For a credit score, a 20-point move is substantial. For Treasury, 0.5% or 50 basis point move is significant. You can check your general credit score from most bank accounts. Like in Chase, I have free credit monitoring. Capital One and SoFi also have something similar. For Treasury rates, check online by searching 10-year Treasury rates. So these are the 4 key fundamentals. Select the right loan type from the cheapest onwards. Select the loan options that will work with your budget. Shop around with 4 to 5 different lenders. Reapply and refinance over time when you either see a credit or the market environment change. In future videos, I'll go over the different loan types and how they work in greater detail. I hope these 4 fundamentals help you get the most competitive rates. Let me know if you have any questions in the comments. Thanks for watching. I'll see you in the next Frugal videos.